Hello, I am Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. I'm going to pick up right where we left off in yesterday's discussion and video, where I talked about the critical point of the aggressive grid strategy being when it reached saturation. That is when my grid reached a full 123 levels and the stop losses started kicking in. I said in yesterday's video that I didn't expect it to take very long, and sure enough, the market did not disappoint. The results were really quite interesting and amazing, but I also found some other interesting things within my logs and analysis that I'm going to go through and talk about in this video, specifically with how stop losses affect the entire process and how they are very aggressive and dynamic. So before we get into the log, let's actually look at the statistics. So we went from $157 profit yesterday down to $22 today. We took that many stop losses between yesterday and today back to back. Remember when I said that those stop losses were going to hurt like hell? They did. But the reality is that is part of the process. The entire market moved aggressively, and I do mean aggressively. The whole process worked. Not exactly the way we like it to work, but nonetheless it worked. The market moved against the positions I had, and subsequently it really took a beating. That's something that you have to expect when you're dealing with hyper-aggressive trading. And this is why I said yesterday that budget was so important. Remember that my budget for the French vanilla account is $10,000, of which I've allocated to each pair $5,000. Now let's get into the slight little nuance that I talked about yesterday. I'm only allowing $4,300 to be used in the pair, or 43% of my total balance. Why? Because I've set a reserve of $700 for my stop losses. It's not a matter of if you're going to get a stop loss or multiple stop losses. It's a matter of when. So I have a $700 reserve that is going to be marginalized by the broker and fluctuate based upon my stop losses. So let's actually look through the log now and see those stop losses in action. Okay, here we are at the log, and I have filtered out the buys and reductions. We're only going to be looking at the sells and stop losses. And we are up to now 4,800 trades. So we're doing quite well in terms of just how aggressive we're building. Now the column that we want to focus on is really right here. The 10,050 and how it's going to be affected over time with the stop losses. The other column you want to focus on is the one right next to it, which is the actual profit or loss for an individual trade. And we can see here the price that the sell took place at and the number of units that the sell occurred at. Remember, it is important to keep in mind that OANDA requires the FIFO regulation. So, orders that are the same size, the oldest will sell before the newest, which can be a pain, and sometimes glitches cause these things to stack up, but they're not insurmountable. The grid bot will actually take care of it on its own. But we can see, though, over time, some rather unusual positions as it looks at the market and makes decisions. And those decisions pay off with some very generous profits. So let's start getting down into where the first stop loss is. Okay, 322 units, and it got triggered at this price, and we lost $4. Now we see that our budget didn't take that much of a problem. The position was 6 days old. So we went from $10,049 to $10,045. Of course, it would be nice if all we ever had to worry about was just one stop loss at a time. But the market is never that nice. So let's keep going. We see some sideways motion, and we see some profits. And we see how the profits can quickly regenerate with this hyper-aggressive technique. But then we get hit with another brutal stop loss. And here's something to be aware of when you're looking at this. 322 units versus 569 units. The discrepancy is the constant reduction that is done with every positive sale. So in this case, I literally burnt off roughly 200 units with every positive sale. So instead of an $8 loss, I only took a $4 loss. So I literally cut my losses in half on the first stop loss because of burning off 1 unit at a time with each successful and profitable sell. Let's keep going. And we have another stop loss and another $8 hit. So we can see how the market is moving, and we can see with every single situation that the rules are being followed aggressively. In order for the grid to move in the direction we want, the oldest position has to be liquidated, and that is absolutely critical. And we see how that works and how that plays out. So before we can buy into a new position, we have to get rid of the oldest position when we are at saturation. And you can see that the stop losses add up brutally. So we've gone from 10,050 down to 9,994. Stop losses hurt. This is why you don't want to use your entire budget. This is why you want a reserve. So based upon this information, the $800 demo that I'm running is going to get wasted. We can see this now. So we can see that all of the garbage over YouTube saying that you should just be able to make $200 by the time you get to saturation is not going to be true. Risk management needs to be built in from the very beginning. So we can already see that the $800 test example is most likely going to fail, just from what we see here in terms of a test case with a $700 reserve just for stop losses. We've blown through roughly $60. So let's keep going, and we see now more sells. So the market settled down. It's back in a range. That's good. That range means we're going to be able to regenerate our profits that we just lost. So let's see how well this works out as we watch this number down here. So we've gone from 9994 all the way up to 9996. So it's doing excessively well. Let's see how long this continues and how much it rebuilds. We're up to 9.7, 9.8, 9.9. And we're back to our beginning balance. We started with $10,000. We're back to $10,000. So we regained back to where our balance was when we started. So let's see how well this continues from here. Okay, we're going nicely. We can see that the hyper-aggressive technique is actually doing well. And where is it? Okay, we can see something here that we need to talk about. Right here, we go from 5 back down to 10,000. Why? Something you have to be prepared to accept when you trade multiple assets in the same account is that you only have one global balance of that account and the other asset is going to play a role. So if it takes losses, this bot or this side of the account is going to see it in the balance. Ideally, it would be great to be able to trade one pair per account, but splitting your money can cause you bigger headaches sometimes. So you need to understand that you're dealing with a dynamic of not just one asset, but potentially multiple assets in the same account with the same resources. In this case, 43% of my $10,000 budget is on this asset, Euro USD, while the other 43% that I'm allowing to be used is on USD Canadian. So you're going to see the budget fluctuate based upon how both assets work together. And that has to be part of your planning process when you're looking at what pairs to trade. Will they both go in the same direction, or will they both go in opposite directions? As you decide your trading technique and your trading structure, these are things you have to look at. For example, here we see we got up to 10,003, then we're back down to 10,000. So whatever is going on in the other side of the account is having a direct impact on our monitoring abilities within this side of the account, which is why you want to pay attention to your actual profits per trade. And it might even be worth taking this into a spreadsheet and then running calculations that way. Or like I did with the GridBot program itself. This program, for example, it looks at only the asset itself and it sees how prices change. For example, here for the Euro USD, it is now 132.65, but down here it is 132.22. So we actually see that individual change on that individual asset. And we see that our total profits went from 22.61 now up to 23.29. So the hyper aggressiveness is rebuilding the account, but it's doing so on a dynamic level between both sides. So let's keep going and see how this plays out. We can see that the market back and forth is really wreaking havoc on the profits on the global level, but overall it is really doing what it's supposed to do. The technique is 100% successful and is showing how it can recover aggressively. Because Okay, let's get back into this now that the internet is no longer playing havoc with me. As I was saying, we can see how the balance is aggressively and dynamically shifting as the markets between both sides work back and forth. We see now that we've already gotten back up to $10,010. Let's continue and see how well this works. Let's skip ahead a little bit. We're back up to 10,014. Whoops, we are now gone from 10,014 back down to 10,010. So again, the market fluctuations have shown the dynamicness of the process. Back up to 10,014, 10,015. So you can see just how quickly a few dollars can come and go with this process when you're trading multiple pairs. And we can see that the holding times of the positions can go very quickly to positions that are several days old. For example, these positions were 2 days old. So the hyper-aggressiveness can actually fluctuate very radically within the process itself. And we see that we are now at 10,016. And we are continuing decline. Okay, so let's see how this does. So we went from 10,023, 10,020 to 10,045. So we gained from the other side $20, and it affected the budget here. That's wonderful. But how does that continue to play out? Let's see. Well, we're up to 10,055, and we get a wall of stop losses. All of our beautiful profits just got slammed by a huge, dramatic market move. But again, we see the result of what the reduction does. This is what it would have been without reduction on the very first stop loss of this wall. $18 loss. The reduction literally reduced the very first loss by 2/3. So instead of the very first loss of this wall being $18, we only lost $6. So giving up a little bit of profit for every successful trade turned out to be a winning strategy. Now, nothing is going to stop a wall of stop losses from hurting. I mentioned this yesterday. This is going to hurt. So we went from literally $10,055 down to $9,901. That hurt. But we see the process still worked. Overall, we are seeing how this whole market just moved. And it moved in a brutal way. This is why a traditional grid strategy will always fail. Always. If it doesn't move with the market and it doesn't deliberately see where the market is going towards, it's always going to be a loser. This process, even though it takes the losses, it moved the entire grid with the market. That is critical. That is why the floating grid technique is successful on all levels. The successfulness of a particular budget is the part that's questionable. For example, a hyper-aggressive technique with a $10,000 budget does look successful. A hyper-aggressive technique with an $800 budget is going to be a bloodbath. That is just the reality of the situation. But a defensive technique with an $800 budget is going to be a spot-on winner. So using the level of aggression appropriate to your risk and budget will guarantee you a reasonable level of profitability while being able to weather the market in a long-term situation. So let's continue and see what else is going on. So now that the market has moved and it looks like it has settled down, we are going back into making profits. So as we see, we begin to slowly begin rebuilding what we lost. It's a painful process, but it's a necessary process. We see that the bot took on different decision-making processes and critically decided how to manage it safely. It protected the account by taking those stop losses. A normal grid situation would have entered into a margin call instead of those stop losses. We don't have a margin call. Remember, we are at full saturation here. That is critical. Full saturation means you are literally pushing the level of your account. If you had used 50% of your account altogether and not actually kept any reserves aside for your stop losses, you would be in trouble right now with your broker. You would have 48 hours to take hard losses, and that would be devastating. By having the reduction process on the oldest unit, and by limiting your actual balance, taking into account the fact that you are going to take stop losses, this method protected the overall account. It protected the balance. Sure, we lost some money. We lost $133 in that wall of stop losses. But the reality of it is that's better than losing $600 or $700 or having the entire account taken because of a margin call. These are risks that you have to be aware of in the real world of trading. This is why when you test and evaluate grid trading strategies, you must focus on what happens when the grid reaches saturation, because that is what really decides the true success of the entire process. Showing just 100 trades isn't going to give you a good look at how the market is going to behave in the long term. You have to see, no matter how long it takes, what happens when the grid reaches saturation. What is it going to do? Is it going to survive? Is it going to continue? Is it going to maintain a way of being able to rebuild its balances? All of those questions are why you need to run the tests in a demo account. All of the questions that I just asked are what you're not going to find on any channel that's just trying to scam you out of your money. A real market situation with a trading approach that is successful and deliberate in its intent will show you all the dirty sides of it, like I just did. Real stop losses, real losses, real understanding of market dynamics and how that plays out. So even though we took a $133 loss in one 24-hour period, we kept our account. The grid moved with the market, and we are back to rebuilding it aggressively. And we can see from the first set of stop losses just how quickly that can take place under the right conditions. Meaning if the market is moving in our direction. Remember, the market is always going to move against you, 15% of the time. The market is always going to move for you 15% of the time, and the market is always going to move sideways 70% of the time. So 85% of the market, you will make money slowly, consistently, and meticulously. With proper risk management, proper understanding of your budget, and really understanding the technique, I could say reasonably well that this situation works nicely. It is profitable, providing you plan for the worst case situation the way I did. A $700 reserve for stop losses, using only $4,300 of my actual $5,000 budget for this asset. Now, that might not be defensive enough depending upon what market you're trading. You might only want to use $2,500 or $3,000. You need to set those levels appropriate to your own risk assessment. And those levels are automatically going to affect your position size. Your position size is going to affect the profitability per a single trade and the amount of loss per a single reduction. You can't just look at the entire process and make snap decisions whether or not the trading is appropriate. Meaning you just can't say, well, I'm going to take a $1,000 budget and I'm going to trade 800 units at a time. You have to work out the mathematics. You have to take time to understand the margin, the net asset value, and how all of it plays together in your account. Use the demo account judiciously. It is the best thing you can do to give you an edge over 90% of the traders in the market. Even when you do start trading live money, always use your demo account. It is critical. This technique is an example of what you see when you take the time to really study the market on an aggressive and large scale. And I am going to continue watching this till I get to 10,000 trades. Just for the simple reason that we need to see what happens in the long term. Because as we can see, this just wiped out $133 in a 24-hour period. What happens if we get a real hard market? We saw what yesterday's market was, with an extreme bullish run when I'm trading short. That hurt. What happens if you get 2 or 3 days in a row of that? That's the kind of stuff that you have to study, that you have to test, that you have to evaluate. And that is why I'm going to continue this particular experiment. So now let's wrap up this discussion with what I think is going to happen with my $800 experiment. Okay, here we are with the $800 demo account on Blueberry Cobbler. We've taken 383 trades and we have a 10% profit. Now we are nowhere near saturation, but nonetheless, we can clearly see that having that reserve zone for stop losses is absolutely critical. So when this thing does reach its saturation point, having that extra padding is absolutely vital. Okay, so as we can see, the budget fluctuates just like it does in the larger accounts, but on the smaller basis. And you can see that your profitability at this level isn't going to be very good. So you really need a bigger buffer, a bigger reserve, and more padding. It's going to hurt. But the problem is when you have a budget this small with an aggressive position, you can't go below 1 unit. This is as small as you can get. And because of the FIFO regulations, This is how you have to manage the account safely in order to protect your trading as much as possible. So my prediction for this account is that it is going to blow up. Straight out, bottom line, it is over leveraged. This account should have at least $1,000 in it for this kind of a technique. Or, very simply put, if you have less than $1,000, do not trade aggressively. Trade defensively with 10 or 20 pips between each trade. Spread it out so that you can handle a 1,000 pip or a 1,500 pip market movement altogether. That way you stand a better chance of absorbing your stop losses when they do hit, because you're not being so aggressive. So leave a comment, let me know what you think. Is the aggressive technique something you would use in your own trading? Or would you use the defensive technique? Personally, I think both have a place, and I think it's appropriate to one's own risk assessment. But I think the aggressive technique is not something you should use if you don't have at least $10,000 total budget. Now, if you're only trading one asset, then you can get away with a $5,000 budget and do very well, as long as you plan for the worst case situation of those stop losses. Let me know what you think. Share your thoughts. Please give this video a thumbs up and help me grow the channel. Thank you for watching.